right, welcome back to the Beyond Wealth Advisors monthly economic update. I'm John Cleaver, partner and senior financial advisor, and with me today is Scott Hawker, financial advisor. Welcome, Scott.
Thanks, John. Great to be here with you today. Today's episode is all about the bond market because while stocks grab the headlines, it's fixed income that's telling the real story halfway through 2025.
Yeah, that's right. And as we hit the midpoint of the year, believe it or not, we're taking a closer look at how credit markets have held up and in many ways thrived despite a backdrop of global tension, conflicting economic signals, and really cautious moves from the Fed.
Yes, from investment-grade corporates to high yield and munis, bond markets have shown surprising resilience, delivering some of the most attractive yields we've seen in over 15 years.
Yeah, it's really quite remarkable. So today we're going to break it all down. What's happened, why it matters, what opportunities may be ahead for investors who are focused on income, stability, and just overall smart portfolio positioning.
Whether you're a seasoned bond investor or just starting to explore fixed income, this mid-year check-in will give you the insights you need to move into the second half of 2025 with confidence.
Yeah, let's do it. So if you've been watching the headlines, it's felt like the world's been on edge, from Ukraine and Russia to the conflict in Gaza between Hamas and Israel, rising tensions in Iran, including a U.S. strike on Iran's nuclear facilities. And don't forget the next round of tariff deadlines and extension. There's just a lot of global drama.
That is a lot of global drama.
Yeah, absolutely. So typically when you see that kind of geopolitical unrest, markets get jittery, but not this time.
John, why do you think markets stayed so calm through all of that?
That's such a great question. And honestly, it comes down to strong fundamentals. We've been talking about this quite a bit this year. And despite the noise, the U.S. economy has been resilient, especially in the bond market. Treasury rates have barely moved. Short and intermediate term yields are actually lower than they were in January. And long-term rates, they're just a bit higher.
It really speaks to how solid the fixed income markets have been. Investors expect more volatility, but bonds held steady.
It's really just amazing. And meanwhile, the Fed's really in a really tricky spot, right? And we've talked about this quite often. They're trying to prevent inflation from coming back and also not tipping us into a recession. And so far, neither has happened. In fact, inflation's really cooled off. It's still above their target of 2%, but we're nowhere near that 9% peak we saw back in June of 2022. So Scott, what about the growth side?
So GDP growth has slowed, but the economy is still growing.
Yeah.
And the job market is strong. If Americans have jobs, they're spending money.
The consumer is the engine here, and employment staying strong has helped stabilize everything else. It's one of the main reasons recession fears have really faded. So let's switch over and talk about the credit markets. First up, corporate bonds. Spreads, between treasuries and corporates have really stayed steady, and A-rated and BBB rated spreads had a scare in April, but they've since narrowed back down. What about high yield bonds?
John, those improved too. Spreads tightened by about 20 basis points after peaking back in April. Risk appetite hasn't disappeared. It's just more selective, and investment grade yields are still at some of the most attractive levels in over 15 years. So, John, what about municipal bonds?
Yeah, that's maybe even more interesting story right now because long-term muni yields, not only are they rising and it makes it attractive for a tax-exempt income, but the muni curve has steepened sharply, and that's creating an opportunity for long-term investors. And we'll talk more about that here in a minute. But in the meantime, let's pivot to the Fed. What's the latest there?
Well, at the beginning of 2025, the expectation was for 2 rate cuts by now. We haven't seen a single one. Now markets are pricing in the first cut for September or October of this year and maybe another in December. With inflation relatively tame and no recession, the Fed can afford to sit tight.
That's exactly right. And that's why this pause, I think, really makes sense. They're really not rushing. I would say they're more watching. The bottom line, though, is what does that mean for investors?
Right. It means fixed income is still a very attractive space. Taxable bonds are letting folks hit the 4 to 5% yield target with quality investment. And municipals are even more attractive for those in the higher tax brackets, especially at the long end of the curve.
All right, so is now a good time for investors to reassess their bond allocations?
Without a doubt. Yields like these don't stick around forever. This is one of the best environments we've seen for bond income in over a decade.
Yeah, it's really quite amazing. So despite the headlines, we actually think there's a bit of a calm, maybe even optimism inside of the markets. Second half of the year will certainly bring some surprises, some choppy water, as we like to say, but there's really no reason to sit on the sidelines.
That's right, John. This is a great time to talk to your advisor, get clear on your strategy, and make sure you're positioned to take advantage of what the bond market is offering right now.
Yeah, absolutely. Well, that's our wrap of our mid-year market recap. And we really want to say thank you for joining us here on the Beyond Wealth Advisors Economic Update. We'll be back soon with more insights to help you stay informed and confident with your money. So until next time, thank you.